Thank you everybody for joining us today. My name is Nicole Martins. I'm the Executive Director of Just Share. And we're very excited today to be able to share with you some of the findings from our recent Asset Manager Responsible Investment Benchmark. Today is going to be a high-level look at the methodology and some of the key findings. Obviously, for more detail, we always encourage you to go and read the full report, and we'll pop a link to that into the chat for everyone to go and have a look if you haven't seen the report already. A few quick housekeeping points before we begin. So all the participants will be muted and the cameras are off. You are welcome to ask questions though, so please do so using the Q&A function. You can do that in writing, or you can wait till the end of the presentation and ask questions verbally. If you want to ask a question verbally, you just raise your hand and then you'll receive a request to unmute and you'll be able to ask your question. We are not going to moderate the questions in any way. We will try to address as many as time allows. If we do not get to yours, we will follow up after the session. So please don't worry if we don't get to yours. But the real value of these sessions is always in the discussion. So we'd like to encourage you to be really interactive and to ask us questions and share your comments. So today's webinar is going to offer a high-level overview of the findings of our research. My colleague Karishma is going to shortly walk us through the methodology and the key results. And again, we encourage you to read the full report if you want any detail, nuance, or firm-level analysis. But first, let's start with some context. The asset management industry in South Africa has real potential to lead globally in responsible investment. Many of the country's largest asset managers were founding signatories of the Principles for Responsible Investment. Regulation 28 also requires institutional investors and network asset managers to consider environmental, social, and governance factors in their investment decisions. National Treasury has further advanced this agenda through its Sustainable Finance Initiative, including development of the Green Finance Taxonomy. Organizations like the IFC and BATSITA support industry capability building in this space as well. And then, of course, the Financial Sector Conduct Authority also runs a well-developed sustainable finance program. So many asset managers in the market do state that they practice responsible investment. They say that they integrate all material factors, including non-financial ones, to achieve the best long-term risk-adjusted returns. Taken together, this means that the industry is really well positioned to produce global leaders in responsible investment. So our research sets out to test how this potential shows up in practice. The results, as you'll see, suggest that the promise is not yet matched by performance. Our report presents a clear framework for best practice, which we hope will act as a guide for both asset managers and asset owners who mandate them as they work towards a higher standard. With that, I'm going to hand over to Karishma to take us through the methodology and what we found. Karishma?
Thank you so much, Nicole, and welcome everybody. I'm Karishma Bhulia. For those who haven't met me, don't know who I am. I'm one of the senior climate risk analysts here at Just Share. I think now we're going to dive into how we actually conducted this research, which is important because understanding the methodology is what makes it credible and also what makes it comparable to a global standard. So for some setting of context for what we looked at, we assessed the 20 of South Africa's largest asset managers against global responsible investment standards. The assessment covered 4 themes. We looked at governance and stewardship, we looked at climate change, biodiversity, and social impacts. Critically, this survey looked at ShareAction's global survey methodology, and it used the same framework that was applied to 76 global asset managers overseeing more than $80 trillion. This means we can directly compare how South African managers stack up against their international peers. All data in the survey is based on publicly available information, updated as at end June 2025. This was deliberate. We used information in the public domain because we wanted to have clients and beneficiaries having ability to scrutinize this. And if it wasn't in the public domain, we didn't consider it as valid. And we also engaged with asset managers to verify our findings. And the positive thing was that 15 out of 20 managers, so 75% of asset managers in the survey participated in this review. The full report, as Nicole mentioned, is available on our website, and we will share the link in the chat. When we looked at the selection criteria, the largest asset managers were selected based on the Alex Forbes 2024 Manager Watch Survey of retirement fund investment managers. We excluded umbrella organizations that do not set policy at a group level. In those cases, we assessed subsidiary holdings. We also excluded private equity and alternative asset specialists, as well as consultants, administrators, and brokers. When we looked at the scoring framework, the full survey included 87 questions. From these, we identified 20 key standards across the 4 themes. So 6 in climate change, 5 in biodiversity and social impacts, and 4 in governance and stewardship. Each institution was assigned a grade based on how many of these key standards it met, and this gave us a clear and comparable measure of performance. Higher point allocations were given to questions of greater significance for responsible investment, and some questions were used as informational and not scored. Let me walk you through the research process itself. The process was designed to be rigorous and collaborative with multiple review stages. In phase 1, all of the asset managers were sent a pre-filled survey submission based on our analysis of their publicly available information. This was scored strictly against international best practice, and the initial results were not great. Phase 2, managers were then given the opportunity to review and provide feedback on all the questions. This was a genuine opportunity for managers to point us to information that we may have missed. In phase 3, the Just Share research team reviewed all the findings and compiled the initial scores. And then we had an additional phase, which was phase 4, where we went back and reviewed all of the data given to us by South African managers and gave many managers the benefit of the doubt wherever possible. The key message from this process is that the process was not designed to catch anyone out. Just Share actively sought to engage with managers and give them every opportunity to display their responsible investment credentials. So the results we're going to present today reflect the current state of the industry. Now we should look at what we actually measured, and these are against 20 key standards. The 20 key standards were organized across the 4 themes: governance and stewardship, climate change, biodiversity, and social impacts. We then applied a double materiality lens to all the themes, considering both risk mitigation as well as real-world impacts. The 3 cross-cutting principles that run through all of the standards are, firstly, transparency and disclosure. We looked at whether the information is in the public domain or whether it was limited, scattered, or only available on request. Secondly, we looked at policies and targets. Here, we looked at whether there are time-bound, specific environmental as well as social targets, and these needed to be clear and detailed policies on engagements, escalation, and exclusions. And lastly, we looked at portfolio coverage. We looked at whether these targets and policies and disclosures covered 100% of assets under management, not only selected funds or investment strategies. When we looked at these key standards, I think it's important to remember that these standards should be seen as a pathway. They're a journey that asset managers need to travel. Let me give you a quick walkthrough of what the standards look like across each theme. For governance and stewardship, these were the underlying principles that underpin everything else. So governance is foundational. Without transparent disclosure and robust stewardship practices, all other responsible investment commitments lack credibility. The governance standards looked at whether managers publicly disclose sustainability metrics across all their portfolios. They examined whether engagement policies include clear objectives, defined escalation processes, and time-bound triggers with consequences for failed engagement. And they looked at voting records as well. They assessed whether managers support environmental and social resolutions at AGMs, or whether they consistently vote with management. For the climate change standards, this was the highest weighted theme in the survey at 30%. Climate change carried the highest weighting because it represents such a critical systemic risk. South Africa is classified as a climate hotspot, and the physical and transition risks are material to every portfolio. The 6 climate change standards assessed whether managers have credible transition plans with interim targets, whether they restrict fossil fuel investments across the majority of their funds, and whether they conduct climate scenario analysis. And lastly, it looked at whether they demonstrated any escalated engagements across climate change topics. The key point again here is not whether managers have net zero policies, rather we assessed whether the pledges were backed by concrete plans and accountability mechanisms. The biodiversity standard, this is an emerging frontier and was the weakest area across the survey. Biodiversity and nature risks are still relatively nascent in the ESG space, but that doesn't excuse inaction. There are globally established frameworks and tools available, such as the TNFD and the Finance for Biodiversity Pledge, as well as various sector-specific policies. The 5 biodiversity standards assessed whether managers have conducted biodiversity impact assessments, whether they have assessments for high-impact biodiversity industries such as mining, agriculture, and fisheries, and whether the policies have restrictions on global areas of global biodiversity importance. Global GDP depends on functioning ecosystems, so this is not a niche concern, it's a material systemic risk. Lastly, the social impacts looked at human rights, labor rights, and the just transition. The social standards examined whether managers have investment policies that commit to restrictions on companies violating human and labor rights frameworks. They assessed whether managers exclude controversial weapons and tobacco from the majority of funds, and they looked at whether managers have free, prior, and informed consent policies. Critically, while managers reference human rights frameworks in their policies, we assess whether there are actual investment consequences when companies transgress those frameworks. Okay, now that we understand how we looked at everything, let's look at what the results say and how asset managers in South Africa stack up against these standards. This is a heat map, and that should give you the full picture of the results at a glance. Red indicates poor performance, and what you can see almost immediately is that the map is overwhelmingly red, particularly across climate change and biodiversity. When we look at the theme-by-theme observations, South African managers fared relatively better on governance metrics, which can largely be attributed to the influence of the King Codes on South African corporate culture. But better is relative, and stewardship scores are still well below international best practice. Climate change and biodiversity, as you can see, are almost entirely red, and these are the areas of greatest failure. When we look at social impact, performance here was tepid with some limited activity, but again, falling far short of global best practice. When we look at some specific manager observations, in general, we can see that larger managers performed better than smaller firms, but there are some important exceptions. The PIC, with 2.69 trillion under management and a developmental mandate, scored poorly across all themes. This is a bit concerning, as it should be leveraging its ownership rights to act far more decisively to steward capital towards a just transition. Conversely, though, when we look at a manager such as Truffle, ranking at number 6, that is proof that smaller managers are fully capable of performing well against larger firms. So size should not be viewed as a barrier to responsible investment. So when we look at that heat map, let's put it in a global context. The key headline here is that South African managers are definitely lagging behind their global counterparts. 85% of South African managers received E or F grades, with scores below 25%. By contrast, the global picture is mixed, but definitely not as stark as South Africa. 51% of managers in the global survey received E or F grades in the ShareAction survey. No South African managers achieved an A, B, or C grade, not a single one. Our top performer, 91, received a D grade with a score of 30%. This would place it 24th out of the global 76 managers assessed by ShareAction. When we look at the global context, the top global performers were Robeco and APG Asset Management, both European managers, meeting 16 out of the 20 key standards and achieving A grades with scores of 76 and 75% respectively. European managers in the survey consistently outperformed other regions. The highest performing non-European manager was Japan's Nomura, which received a C grade. The largest global managers, so we're talking about BlackRock, Fidelity, State Street, and Vanguard, also received D, E, or F grades. So it's important to remember that underperformance is not unique to South Africa, but the depth of the gap in our market is significant. 10 of the 76 global managers met more than half of the standards, whereas 0 South African managers met more than a quarter of the standards. So we've distilled our analysis of these findings into 3 interconnected findings that should explain the performance gap. The first one is inadequate disclosure. We found that public claims are not substantiated by transparent data. This undermines accountability and limits the ability of clients and civil society to assess managers against actual practices. Secondly, we look at weak stewardship. There is a definite preference for ad hoc and closed-door engagements, which in our interpretation reflects a lack of robust policies, clear engagement objectives, and lack of meaningful escalation tactics. The key finding here is that engagement without accountability is ultimately just performative. And lastly, we're seeing inaction on systemic risks. Despite South Africa's heightened exposure to both physical and transition risks, current practices have really shown to have very, very limited real-world impact. Managers are not planning for the transition, and this introduces undue risks into long-term portfolio resilience. I think I'm going to take you through each of these findings in a little bit more detail. So firstly, let's look at the issue of inadequate disclosure. There is definitely a transparency problem in South Africa's asset management context. None of the top 20 asset managers publicly discloses sustainability or responsible investment metrics across their portfolios in fund fact sheets or any similar documents. What the research found is that information is scattered across multiple reports that are not necessarily consistent or updated year on year. Marketing campaigns and website pages often promote the image of managers as responsible investment pioneers, but those claims are actually not verifiable with public reporting. And this matters for both sides, both asset managers as well as consumers. For consumers, it should be relatively easy for them to access and understand the climate and social risks of their current as well as future investments. Funds should essentially do what they say on the tin when it comes to ESG. But with the current levels of disclosure, this is near impossible. For managers, there's a bifold risk here. Transparency, firstly, actually makes data collation, completion of surveys, and competing and dealing with competing data requests much, much simpler. Having more information in the public domain would go a long way in easing the questionnaire fatigue many managers mentioned when we circulated the survey for comment. Public disclosure would also mitigate some accountability risk. The potential misrepresentation of responsible investment claims will come under increasing scrutiny as regulation and public development in the debate here intensifies. The FSC's current regulations on misrepresentation may soon extend to green and sustainability claims for funds. The second key finding was around weak engagement practices. And this really matters considerably more in the South African context. Engagement over divestment and restrictions is something we hear often from all South African asset managers. At Coronation's recent AGM, Carl Leinberger of Coronation reinforced the importance of investing in and stewarding poor corporate citizens in the South African context. The research really agrees with this sentiment. Engagement is critical, particularly in the small investable universe in South Africa. Managers cannot simply divest from poor-performing companies. The market is too concentrated. This makes effective engagement even more important. Asset managers have real power to steward capital and facilitate a just transition. But what the research found in this context was concerning. The evidence suggests that under half, 45% of asset managers surveyed disclose an example of escalated engagement on climate, biodiversity, or social impacts, with only 3 managers demonstrating escalated engagements for more than one theme. While most asset managers have an engagement policy, none of these policies actually met the requirements of the key standard. The standard requires a defined escalation process with time-bound triggers and consequences for unsuccessful engagement. Stewardship reports also rarely outline clear engagement objectives or timeframes. They do not provide full lists of engagements or report on unsuccessful engagement outcomes. And lastly, managers are also failing to set clear public expectations for investee companies with respect to climate, biodiversity, and human rights. So what this means is that engagements are ultimately ad hoc and rather than strategic because they lack that systemic clear anchor to guide them. Our key takeaway from engagement and the weaknesses around engagement practices is that the setting of time-bound expectations for progress helps ensure that engagement processes don't fail. Companies need to know what is expected and what the consequences are if they fail to make progress. This is even more important in a small investable universe where the relationship between the asset manager and the company is ongoing and exceptionally close. We also looked at the really big strategic gap around the fact that asset managers are just not planning for the just transition. Without clear transition planning timelines and targets, there is absolutely no strategic anchor for engagement. How can you engage with a company on its transition progress if you haven't defined what your own transition looks like? This gap is evident in a variety of ways. Notably, only a quarter of South African asset managers report using scenario analysis covering both transition and physical risks. Globally, over 3/4 of asset managers already use scenario analysis. Without scenario analysis, managers are almost flying blind. They haven't stress tested their portfolios against different warming scenarios. Secondly, only 3 South African asset managers have set any net zero targets, compared to 80% of global managers. Only 1 manager, 91, has disclosed a time-bound carbon transition plan to phase out fossil fuel investments. This introduces undue risk into long-term portfolio resilience. Fossil fuel investments will continue across the sector without adequate planning for how those positions are going to be managed through the transition. Engagement in this context becomes even less effective because investee companies' transition progress is not explicitly linked to managers' own planning and targets. There is really a fundamental double standard in asking an investee company for a transition plan while not having one for your own portfolio. And when we look at this in the context of a just transition ensures that a shift to a sustainable economy distributes benefits equitably and does not come at the expense of vulnerable communities. Despite managers emphasizing the importance of a just transition, evidence of this translating into actual capital allocation shift remains minimal. Here we're seeing a lot of rhetoric that is not substantiated by action. Another key finding was how we looked at how that translates into 2 key themes, particularly biodiversity and social impacts. And these were by far the worst performing key standards. 90% of managers failed to meet any biodiversity standards, while 80% of managers failed to meet any social impact key standards. There is a notable blind spot for biodiversity in the sector. So while biodiversity and nature risk are relatively new in the ESG space, it is a little bit understandable that many managers fared so poorly on this theme. That being said, there is globally established best practice and tools available already for managers who are willing to act on biodiversity. On social impacts, however, the performance was a little bit more concerning, given South Africa's socioeconomic challenges. Social impact and environmental action are fundamentally interconnected and not competing priorities. Failure to address climate change and biodiversity degradation disproportionately affects the country's most vulnerable communities, exacerbating existing inequalities. And when we look at the specific gaps here, South African managers across the board note the importance of human and labor rights frameworks, but none have investment policies that commit to restrictions on companies that transgress these frameworks. Only 2 managers have exclusions for controversial weapons. Tobacco as a sector is largely unrestricted across all portfolios in South Africa. And when we look at disclosure on social impacts more broadly, these remain minimal at best. Before we move to specific recommendations, I think it's worth recapping the so what of these findings. So firstly, without transparency, there is no real accountability. Managers should prioritize transparency and improve their public disclosures. This would work better for managers as well as for consumers and other investors and stakeholders. Secondly, engagement without teeth is largely performative. Managers should publish robust policies with clear engagement objectives and defined time-bound escalation tactics. And lastly, the stakes are really too high for us to continue with business as usual. The systemic risks facing the South African context require responsible investments that deliver real-world impact. Something we heard from a lot of managers was that their inability to set targets is based on them wanting to transition to real-world impacts rather than portfolio decarbonization only on paper. But without clear policies and strategic guidance for engagement, we're not really going to see any real impact. So we looked at what the recommendations would be for various stakeholders in the South African context. And I'm going to unpack a few of these now. So these recommendations are the so what now. We've looked at the South African industry against global best practice. We've looked at what the key gaps are and identified cross-cutting themes to help us address them. So what are we supposed to do with this information? And we looked at this across three sets of stakeholders. Firstly, asset managers, then asset owners and consultants, and lastly, we looked at it in the context of policymakers. So for asset managers, we want asset managers to use this benchmark to identify and address key areas for improvement. The key standards should be considered a minimum set of expectations. Leaders should really aim to go beyond these standards. We were hoping to see that managers drastically improve their public disclosures on policies, engagement approaches, and portfolio metrics. Transparency really should be the foundation on which responsible investment is built. And we'd like to see that translate into clear, time-bound escalation triggers in engagement policies. Engagement with accountability is really not stewardship. For asset owners and consultants, we're hoping that these findings will be used to assess and challenge managers. Asset owners really have the most to lose from inaction. The systemic nature of the risks means that you cannot simply diversify away from them. JustShare is encouraging asset owners to integrate this benchmark into manager selection as well as the review process. We're also looking for asset owners to set clear best practice expectations for responsible investment performance across their investment mandates. Asset owners really have the power to hold asset managers accountable. Something we often heard in our consultations with both managers and consultants is that managers constantly tell us that they're just working on a mandate and they cannot do what's not specified in their mandate. So if asset owners are a lot more proactive with their mandates, we can start seeing some real shifts in responsible investment practice. And lastly, for policymakers, we would like policymakers to use this benchmark as a way to identify sector-wide weaknesses and determine appropriate policy action. The evidence here is quite clear. If you use examples of global practice as evidence of what is possible and achievable, that can largely refute arguments that the standards are unrealistic. And we'd like the policymakers to consider mandatory disclosure requirements to elevate standards and set kind of floors and ceilings for global industry best practice. The correlation between regulation and performance, particularly in European markets, is hugely instructive. So that was quite a whirlwind through everything that we covered in this benchmark, but I think I'd like to, before we go to questions, leave everyone with this. And is that the benchmark is not designed to be an impossible set of ideals. It was designed to be a measure of what is already being achieved. The real question here is around whether the South African asset management community, who is entrusted with the retirement savings of millions of South Africans, will rise to meet the challenge. So thank you everyone for your time and attention. I think, Nicole, we have enough time to get through questions and any comments that anyone might have.
We do indeed. Thank you so much, Karishma. And as we mentioned at the outset, this was a high-level look at what we found. We've encouraged you to go and read the actual full report. Thank you to those of you that have been sending in your questions in the written boxes. I'm going to go through some of those now, but a reminder that if you would like to ask a verbal question, you are more than welcome to do so. You just need to raise your hand, and then we'll give you a request to unmute, and then you can ask your question. But for now, I think we'll dive into some of the questions that have come through. Anthony, I see your hand. I just want to do this one question, and then we'll jump to you. How important is it for asset owners and consultants to do their own research and assessment of managers? Is it sufficient due diligence to leverage off the work done here by Just Share? I think that's a fantastic question. So thank you very much for sending that one through. Obviously, it's really important for asset owners and consultants and multi-managers to do their own due diligence. This is a great framework to use. So as we mentioned, it's an international best practice framework. So it's a great framework to use. It's publicly available. You can have a look at our report and see the methodology. It's a really good starting point. But as Karishma mentioned, it's the bare minimum. So the goal should always be to push managers to do more than this. But I think if you want to use this as a starting point for a conversation, I think you're more than welcome. And I think that it's robust enough to do that. But it's always good to do your own due diligence and align that with, obviously, the investment philosophy and mandate of your own house when you're making those selections. Anthony, we can unmute you.
Hi, yes, thanks. So I had to battle to unmute myself there. I think the difficulty we had a bit with this was this was done in early 2025, and it takes a couple months for our reports to get out from the end of year. So our submissions are based in 2023 data. So I think the difficulty we have is we're kind of looking in 2026 at stuff done in 2023 for some of the participants, and that leaves it a little bit dated.
Yeah,
So
no, I think that's a good point.
Yeah, so we did invite comment, but I don't think we had much opportunity to catch up with Karishma. So I think we did struggle a bit with that, a bit dated. We also battled to find the standards. So I must question. I mean, the standards look interesting, and we are going to study them, but they seem to be from an NGO in the UK, and we can't kind of pick anyone else who's used the standards. So maybe you can just share some more information around how you came to this, why this is a good standard to follow. Thanks.
Sure.
I think I can take that. On the dating, definitely. I think we did the best we could because we had to circumscribe time, and we wanted to look at everyone in the set specified time with what was available publicly as at June 2025. The cadence for this report will be biannual, so we do an update in 2027, and I think all the managers in that survey, when we go into that next run, will be invited to share their most up-to-date reporting standards and public disclosures with us. On the feasibility of the standards, and I think that is a great question and something we also juggled with about what we wanted to do and what we wanted to achieve with this benchmark. What we wanted to achieve is a global comparison instead of something hugely bespoke and South African, because we think some of the challenges, in fact, all of the challenges, speak across geographical demographics and across the board globally. And the reason we use the ShareAction survey is because it's been in place for a good 5 years. They run this survey every 2 years, and it's quite an established framework that looks across a majority and integrates a majority of different standards. So they look at what the PRI key disclosures are asking for, they look at what GRI standards are asking for, and they also look at what the European markets, particularly on SFDR, are asking for, and sought to integrate that into a single set of standards that would be best practice across disclosure frameworks. So when we looked at what we wanted to do, we thought this would give us the first kind of foot in for a global benchmark and a global comparison. Going into the next iteration, we could definitely look at what tweaks and changes would make it more relevant for South African context and look at incorporating that into a global methodology. And again, we'd encourage as much conversation and consultation with managers on that as we go into the next round of the benchmark. But for this one, we wanted to be as comparable as apples and apples as possible when looking at South African managers against their global peers. Anthony, I'm not sure if that answers your question. And Nicole, I'm not sure if there's anything you want to add.
No, I think that was really comprehensive, Krishna. I see David, your hand is up. We can unmute David, please.
Hi all. Can you hear me, Nicole?
Yes, we can hear you.
congratulations on your new role, and both of you, well done for some difficult research and challenging research. I think Anthony's hit on a few issues which I'm sure you will consider carefully. In terms of your recommendations, absolutely, the asset owner recommendations are critical in the South African market. And Nicole, you've worked with an asset manager. I've worked with asset managers. And if we look at the mandates asset managers receive, they do not cover these issues in any great detail. In other words, the issues that not you, but ShareAction have integrated into a framework. I think also we need to keep in mind, the pushback that's happening globally. And that's not a reason for being, pushing back in terms of the standards that you apply. But, if you look at the UK, the FRC has changed the UK Stewardship Code. The PRI has changed their framework. It's just moving to 40 questions now. It has improved, but there's a lot of uncertainty as to what is specifically required from regulators, clients, and asset owners around the world. And then bringing in the European SFDR into your benchmark at a time when IFRS and the S1 and S2 are going in a slightly different direction, in other words, not the double materiality, I would suggest that all of these issues perhaps means that the framework that you apply perhaps would be best to have a discussion with the asset owners in South Africa. Because going back to your recommendations, this is only going to materially change if the asset owners participate. So that's my first thought, but well done for pushing things and continuing to encourage improvement in the South African market.
Thanks very much, David. And I couldn't agree with you more. I think asset owners, they really are at the top of the pyramid, right? And it's really up to them to set that mandate and to hand over the instruction, which is exactly what the mandate is. So, Karishma, we can see your slides, your speaker notes. I don't know if you want to just, there you go, that's perfect. Yeah, so I fully agree with you. And I think there is a lot to say about the global pushback and the sort of reshuffling that's happening at the moment. And I think what, at least in my opinion, what's happening at the moment is that there is a violent sifting out of rhetoric and a growing focus on pragmatic strategies and approaches. And to your point, I mean, things like IFRS are coming in and they're really forcing us to get practical and to deal with the data and to try and integrate that into the way we make investment decisions. And so I think to keep an eye on what's going on in those markets is really important. But I think that local context, like what Karishma was saying, is really important as well to integrate. So going forward, I mean, I think we welcome conversations with asset owners and managers around how do we make sure that this assessment is value adding for our market. And the big thing, I think, and it deals with one of the questions that's come through, is around this issue of, is it a question of poor practice or is it a question of poor disclosure? I think that's also something that we need to look at is, are we doing things but not communicating them well? Or are we not doing the things? So there's a lot that we can use, but this is a great jumping off point to have those conversations and to explore those in more detail. Krishna, I think you can just stop sharing your screen. It's no problem. Anthony, I see your hands up again.
Hi, so there's a bit of a lag between the unmute and the aspects. So I've come quite late to this, so I've just jumped out of the ASISA meeting. So if you're missing quite a few asset managers, they're probably all sitting in ASISA still. I'm bunking class a bit on that. So if you're wondering where everyone else is, they're probably sitting in ASISA. I think this needs to be quite a constructive space. So I'm a little concerned. I mean, the highlighting that very few asset managers got a net zero target. So you asset managers have got pension funds. They have to have South African kind of exposure. You're kind of forced to have Eskom exposure. It's very difficult to set a net zero target. Honestly, incredibly, with your clients, they were going to go to net zero, and then you look at Eskom. So I think quite a lot of us are keen on that. We don't know how to do that credibly. And if the regulations don't change, so I think you might find that quite a few people have got very strong plans in place. So we have lots of plans in place. We're not looking for absolute numbers. We're looking for movement. So the way that we look at this is shifting quite actively. But going for absolute net zero, I think we need to make sure we're kind of measuring the right stuff. So I think that as a headline can be a little bit unhelpful to say, well, no asset manager got net zero. Well, it's South Africa. We have Regulation 28. With our benchmark with ALSI, it's going to be nearly impossible to kind of escape that exposure. So what do we do? So I think there needs to be a secondary aspect of saying, yeah, we haven't got net zero. Why not? What's the next best bet? So how do we measure and track movement towards net zero, as opposed to a goal? And all the asset managers can claim net zero and say, look, it's 5 years time problem. And then 5 years time, maybe this has gone away, maybe it hasn't. But I think a lot of us really want to have credible goals in this space. And it's really difficult to set that when you have this exposure and be completely honest and frank. And we're actually having the same conversations with one of our big paper producers, saying that they won't set net zero target. So if they won't set net zero and we're going to have exposure, we can't hit net zero. And they're saying we don't know how to escape Eskom. So we're not going to do virtue signaling here. We're just not going to do it. And you can ask us to do it, and you can see we've got fantastic programs, and we really are moving as fast and quickly as we can. But we're not prepared to make the ultimate kind of commitment. So I think when we do these surveys, there needs to be some additional context. I just worry that to be constructive, we must just avoid kind of attention-grabbing stats. And I know the industry can do more, but it's really got to be kind of a working together space. That's just my 10 cents. Thanks.
Thanks, Anthony. So I agree with you. I think the whole point of this kind of research is to create a platform for constructive dialogue, right? And I think it's important to remember that this is an international best practice framework. So this is the sort of gold standard, if you can just put it that way. And it's an assessment of where we are with that. And so I think, to your point around why are we not able to achieve that, that is where the conversation needs to start. And where can we make changes or engage or collaborate so that we are able to get as close as possible to what's best practice, because it is not going to go away. Climate change is not going anywhere. If anything, it's accelerating. So we do need to have some plans in place. I think it's also useful to align to existing plans that are there. So, I mean, the country does have a net zero target, as does Eskom. The plans are not perfect, but those targets are there. So it's maybe a question of, to your point, collaborating and getting to the bottom of these issues and putting together ambitious but pragmatic plans together. And I think that links nicely to David's point as well about engaging asset owners and talking about where it is that we want to get to and how we're going to get there together. So this is a conversation starter. It shouldn't be seen as the start and end of the discussion. It's really the beginning here. Dana, I see your hand is up. Oh, sorry, Krishma, you want to add?
On that point around net zero targets, again, agreed. The survey wasn't designed to be attention grabbing and looking for you have net zero by 2030 and giving you full marks for that. What it was rather designed to do was looking at what kind of logic have you got behind transition. Transition was the more pivotal thing as opposed to net zero. And I think the gap here in the South African market in particular is we are not seeing anything around how managers are framing the risks around transition, be it Eskom, be it everything about the carbon intensity of the economy. But we're kind of just seeing vague notions around we will engage with high impact, high emitting companies. And we're hoping that we're going to cross fingers and hope that that translates into a just transition. So agreed about not using performative metrics as a gauge of success. But what I think is important is that managers should be framing the transition risks and saying, for a carbon intensive economy, these are where we're seeing the biggest problems and how we're looking at mitigating that. So it wasn't designed to kind of give you ultimate points for just a net zero target. It was designed to look at the thinking behind transition.
Brilliant. Thanks, Karishma. Yeah. So it's all about the actual strategy and the actual plan, right? So that's just an indicator of the sort of seriousness of the plan. Dana, I see your hand is up. We can unmute Dana.
Okay.
We can
I'm
hear
sorry,
you,
can
Dana.
you hear us? Okay.
Yes.
It's actually not Dana, it's Tracy Davies here listening from the Just Share boardroom on Dana's computer, outgoing executive. I do think it's important to respond to Anthony a little bit more robustly, perhaps, than my colleagues have done. Eskom has a net zero target. The country has a net zero target. So to say there's nothing we can do because of Eskom, I think is not a good approach. It is impossible to work towards something if you don't have a target for what you aim to achieve. And so what we find with these disclosures is that they are extremely vague, which means there is no way to hold anybody accountable for what they are doing. And for asset managers to be working with investee companies around transition plans and net zero plans without having their own commitment to those targets is simply never going to get us anywhere. And the other point to make is that the private sector, which consistently throws its hands up and says, what can we do about Eskom, has a huge amount of power over what Eskom does. It holds secondary debt, enormous amounts of secondary debt in Eskom. It is supposed to be part of a huge mobilized corporate engagement with government around how to fix Eskom. Businesses had access to Eskom, high-level access to Eskom for over 2 years now to try and drive Eskom in the right direction. So I just want to defend this was not an attention-grabbing. Net zero targets are a globally recognized way of setting yourself on a path to reducing emissions. And there is nothing wrong with expecting asset managers to have net zero targets.
Thanks, Tracy. I'm looking at some of the other questions that are coming out. So yeah, we've dealt with this. Is weak disclosure masking better performance, or is performance genuinely weak? I think it's probably a combination of the two. So the disclosure is really important because it makes clear what you are doing. If your disclosures are not clear and transparent and comprehensive, people don't have any idea what the targets are, what the plans are. And of course, it's only worth disclosing if you have those targets and those plans. So it's a bit of a combination of both. But again, this is how you start these conversations, right? Is with these kinds of surveys and this kind of data. Here's another one. What is your view on engagement, even if imperfect, that it may achieve better real-world outcomes in the South African context than blanket exclusions? So this is a great question, and I think it's something that we discuss quite often, where engagement is absolutely an effective strategy if it is done properly, right? And that starts with having a clear engagement policy, which has clear steps for escalation with time-bound targets and triggers, and a plan for what happens when that engagement is not effective. So one of the things that we'll hear often in the South African market is that it's a small investable universe, and so divestment is not an option, right? And I think this point was made quite well by Karishma in the beginning. That means you have to engage. It doesn't leave you with really another option. And this is how you mitigate risk in your portfolio and how you take advantage of opportunities. And so it's less a question of, well, we have a small investable universe, and so why bother engaging? And more a question of saying we have a small investable universe, and so we must engage, and we must do so effectively. And what we're missing at the moment is a clear plan for how to do that, a structured approach that includes those targets and those triggers and what actually happens, what is the eventual threat. At some point, that divestment or some sort of escalation has to come into play, and that's what's missing at the moment. I'm reading through some of the others. I don't know if anyone's got a verbal question they want to ask in the meantime. Oh, here's a good one too. PIC, the largest asset manager by AUM and the largest investor on the JSE, scored 8% overall. What does this mean for systemic risk to the entire economy? So that's great. I don't know if we've got any macroeconomists on the call that feel like they want to answer that one, but generally, it's a significant risk for the market. And something, not just PIC, but I think the large asset managers who have such sway and have the potential to actually change corporate behavior for mitigating those systemic risks. So it's incredibly disappointing to see. And again, something that's worth engaging more on and having these conversations. So what is actually stopping this universal owner from, with a developmental mandate, from implementing best practice principles, when if anyone has the impetus to do so, it would be them. Karishma, are you seeing any other questions coming through on your side there? Oh, we have a hand up. David Levinson, we can unmute you. Hang on, David, you're coming through quite garbled. Let's give it another try. It's still quite, no, not really. It's still breaking up quite a bit. Try one more time. Okay, David, I think we'll try and get back to you. No, sorry. I'm not sure what's going on. We can't hear you nicely. Maybe throw your question into the Q&A box and then we can deal with it like that. Any other questions? Gosh, this hour has flown by. We're probably getting ready to start wrapping up. Anthony, welcome back.
Hi, thanks. I think there's some great points made here. I think what's also interesting about Universe is being quite small. Asset managers got quite big stakes in companies, so that does often makes the engagement more effective. Our experience has been that companies are kind of battling to find their way, but genuinely just I'm showing for interest on this platform, are genuinely interested in trying to work in the space and are genuinely typically quite good at disclosure, quite good at engaging, and quite good at engaging around what we want and trying to find what information we need and what is helpful. So I'm sure many of our asset managers are doing the same. We've identified our largest carbon emitters, and then we will try and say, well, what targets have they got? How does it impact us? And how can we move them closer and closer to kind of Paris aligned? And what steps would that involve? But we do find our experience is, and we're a mid-sized manager, is that companies are quite keen to engage on this and quite keen to kind of respond. It does take time though, so this is something that takes quite a bit of movement. So I think your lead times on this are probably, our estimate is about 6 to 8 months to get kind of the first step, and then thereafter you might see something in about 8 to 10 months later. So it's a bit of a ongoing process, and you've got to track these things and monitor them and see how they go. But I do think we're probably going to see quite a bit more movement on the stocks we're looking at in kind of the next 6 months. And then what we're seeing is companies also starting to move to a position where they're crystallizing their views. So Glencore is a good example, and we're quite public about this. Now that Glencore's quite a big US shareholder base, they're kind of digging their heels and saying, we've got targets, but this is as far as we go. And then you can either kind of risk accept that, or, but you're going to get to a point where you say, well, we can't move the dial. Do we exit, or what are our alternatives? What's our play in this position? And I think asset managers also now are getting to the position now where we are having to kind of have that kind of secondary play. What happens when we get stuck? What are our options? What are our tools? And I think that's an interesting space for us as well. We're now in the position saying, okay, now this isn't moving. Kind of now what? Whereas 2 or 3 years ago, you're just asking the question. Now you haven't got the movement. What do you do? How do you evaluate that risk? And how do you handle that with clients as well, with the benchmark? Because they don't allow you to take off benchmark positions on this. So you're trying to balance your legal contractual duty as well, and those conversations are opening up. And I think that's also why kind of David's point is quite helpful, is we need to chat to the asset owners to help drive this. Otherwise, we do end up with our clients coming to us and they want information on carbon, but they also want returns against benchmark, but they won't adjust the benchmark. And that puts us in a very tenuous position, because our first legal obligation and fiduciary duty is to kind of develop returns. And now, naturally, you can also say, well, look, this brings risk, so you must adjust the risk accordingly. But the equation is not quite as simplistic as that. But this is an interesting space. And Nicole, congratulations on your appointment. Tracy, I hear your comments on the net zero. I think we're closer than you think. And I look forward to catching up with you. I think I might be seeing you tomorrow. And we can chat then. Thanks very much. And I think this is helpful work. As I said, I think our data is a bit dated, but I think these surveys are great conversation starters. And I think this is a good place to start, to kind of throw things on the table. And then, but now we must kind of meet to see where we move forward from here. That's it from me. I know I'm taking up airtime. Thanks.
Thanks, Anthony. No, I think there's some good points in there. I think what's interesting is your point you make about the sort of now what, right? So you get to a point where you're not seeing that movement, to use your words. And that's where the research shows us that public collaborative engagement is the most effective for corporate behavior change. So I think there's a lot that we need to do in terms of changing this sort of engagement strategies that are individual, private engagements, and start collaborating more. Because as we mentioned, I mean, these are systemic risks and they affect all investors. As you mentioned, everyone owns a bit of everything usually, and substantive enough to make a difference. So I think definitely worth using this kind of research, as you say, as a jumping off point for some constructive conversations. We look forward to doing that. We'll be reaching out to set those up, to have these conversations. If you want to reach out to us and discuss this in more detail, please do that. We would love to talk to you. We'd love to talk to the asset owners as well. So if anyone is keen to discuss this in more detail, please do reach out to us. In the interim, my job now is very easy. It's just to ask you to have a look in the chat at the survey link we've sent. It's only 5 questions. It'll take you less than 2 minutes. We're getting into doing more of these webinars. We want to get a sense from you whether they are valuable, how we might improve them, and what kinds of topics you would like to discuss in future. So if you can take a moment to just click on that link for us and complete the survey, that would be great. And now my job is to thank Karishma for the presentation and for the hard work that the Just Share team has put into this, to thank all of you for joining us today, because it wouldn't have been the same without you. Thank you for all your questions. And like we said, if there's anyone that wants to follow up on this, we welcome that completely. So please do get in touch with us. And that'll put us on 12 o'clock. Enjoy the rest of your day, everyone. I'll talk to you soon.